What if the most dangerous number in personal finance isn't a stock price or an interest rate, but $10? Picture this. Every single morning, without fail, you take a $10 bill and feed it into a machine. Not a vending machine, not a slot machine. Something quieter, something that doesn't flash lights or play music. It just takes the money and disappears it into a system most people never look at closely. You do this for years, decades, and one day you open the ledger and the number staring back at you doesn't feel real. That number is the point of this story, not because it's inspiring, because it's uncomfortable. $10 a day is the cost of a cheap lunch, a couple of streaming subscriptions, or the difference between filling your tank and leaving a little space. It is small enough that most people can find it if they look, and that is exactly why it matters right now. We live in a moment where the gap between what people earn and what assets cost has never felt wider. Housing, education, even basic stability seem priced for a different generation. So the idea that something as modest as $10 could matter feels almost insulting, or hopeful, depending on the day. But markets do not care about feelings, they care about consistency and time. Assume the money goes into a broad US stock market index, something that tracks the 500 largest public companies. Historically, that basket has returned roughly 10% a year when you include dividends and reinvest them. Not every year. Some years it drops 20 or 30%. Some decades it barely moves. Over long stretches, the average has held near that mark for nearly a century. Now run the arithmetic. $10 a day is $300 a month, $3,650 a year. After 10 years of never missing a deposit, the account sits around $61,000. You put in $36,000. The market added the rest. Not life-changing, not even particularly exciting. Most people would look at that balance and feel a quiet disappointment. The machine is working, but slowly. Keep going. At 20 years, the balance crosses $227,000. You have contributed $72,000. The rest is growth. The curve is starting to bend, but still gently. 30 years. Now the number lands near $678,000. You put in $108,000 of your own money. More than $500,000 arrived from somewhere else. The compounding has become visible. The later contributions are riding on a much larger base. 35 years and the account crosses 1.1 million. 40 years and it approaches 1.9 million. Same daily $10. Same average return. The difference is almost entirely time. That is the first shock. The money does not grow evenly. It grows late. The first decade feels almost pointless. The second decade starts to matter. The third and fourth decades do most of the heavy lifting. This is not a motivational slogan. It is pure mathematics. Compound growth is a curve that spends most of its life looking flat and then turns almost vertical if you stay long enough. There is a second, quieter shock. Most of the final balance is not the money you put in, it is the earlier money earned. By year 30, roughly 84% of the total is pure growth. Your contributions become a minority partner in your own account. That is both the promise and the problem. The system rewards the person who started early and never stopped far more than the person who waited for a better moment or a larger amount. People like to talk about the miracle of compounding as if it is a gift. It is closer to a filter. It filters for duration and for the ability to ignore the noise. Markets fall, sometimes for years. In the early 2000s, the index spent a decade going nowhere after 2 crashes. Anyone who started in 1999 and checked their balance in 2009 saw almost no progress despite continuous deposits. Many quit. The ones who kept feeding the machine through that stretch eventually recovered, and then some, but only because they treated the process as automatic rather than emotional. This is where the popular version of the story usually stops. The internet loves the $1 million headline. $10 a day equals freedom. The math is real under the assumptions. The assumptions are where the discomfort lives. Past returns are not a contract. 10% is an average pulled from a century that included world wars, depressions, inflation spikes, and technological revolutions. The next 30 years could deliver 7%, or 12%, or something closer to the lost decade of the 2000s. Inflation eats the purchasing power of the final number. At a long-run real return, closer to 7% after inflation, the 30-year balance drops to roughly $366,000 in today's dollars. Still substantial, no longer the number that trends. Fees matter more than most people admit. An extra 0.5% in annual costs compounds against you the same way growth compounds for you. Taxes on dividends and eventual withdrawals take another bite depending on the account type. Behavior takes the largest bite of all. The person who stops depositing during a crash or sells after a 20% drop resets the clock. The machine only works if the deposits keep arriving and the shares stay owned. There is also the question of what $10 a day actually requires. For someone earning a high income, it is trivial. For someone living close to the edge, it is a real choice. Consistency is easier when the rest of life is stable. That is not a moral judgment. It is a description of how the system actually operates. Compounding does not care about fairness. It cares about the arithmetic of repeated small additions over long periods. Contrast this with the louder narratives that circulate: crypto overnight riches, real estate leverage stories, side hustle empires that somehow require no sleep. Those stories sell because they compress time. The $10 path does the opposite. It stretches time until the result looks inevitable in hindsight and nearly impossible to start in the present. The irony is that the boring path has historically produced more reliable outcomes for ordinary people than the exciting ones. Reliability is rarely viral. Zoom out further and the implications get sharper. A society that makes early, consistent ownership of productive assets easier will produce different outcomes than one that does not. The person who begins at 22 and never stops ends in a different financial universe from the person who begins at 42 with the same daily amount. The gap is not primarily about intelligence or work ethic. It is about the shape of the growth curve and the number of years available to ride it. That reality sits underneath a lot of the anxiety about generational wealth and mobility. $10 a day does not fix structural problems. It simply reveals how much of the outcome is already decided by when the deposits start and whether they continue. There are risks the clean math never shows: concentration in a single country's stock market, political decisions that change tax treatment or capital flows, demographic shifts that slow growth, the possibility that the next long stretch looks more like the 1970s or the 2000s than the 1980s or 2010s. Diversification across assets and geographies softens some of those risks but never eliminates them. No strategy that relies on future growth is free of uncertainty. Still, the core mechanism remains. Small, repeated ownership of productive capital, left alone for decades, tends to produce results that feel disproportionate to the daily effort. The shock is not that the final number can be large. The shock is how little of that number comes from brilliance, timing, or dramatic decisions. Most of it comes from the refusal to stop. So the open question is not really what happens if you invest $10 every single day. The numbers are calculable. The historical ranges are known. The real question is quieter and harder to answer with a spreadsheet. What does it say about a person or a society when the most reliable path to a different financial future requires treating $10 as if it is already spoken for every day for longer than most people are willing to plan?